That was a long story, but it's just to say real estate is stressful. Even when your loan's fine, everything's going fine on your end.
Welcome to the Veterinary Financial Podcast, where we discuss financial freedom and whole life success. I'm Meredith Jones, a veterinarian and financial planner.
And I'm Willie Bedott, a lab animal vet and a money nerd. Today we welcome back David Aizuss for part 2 of our conversation about the home buying process. David works with Meredith on the veterinarian team at SLP Wealth as a financial planner for veterinarians. His wife is a veterinarian. He's also a student loan consultant with SLP and a mortgage loan officer. David, welcome back to the show.
Thanks for having me again. Pleasure to be here.
All right. So in part 1, we focused on how to set yourself up for success when buying a home. So check out the last episode if you haven't already. In this episode, we're going to focus more on mortgages and how to save money when buying a home.
I'm going to ask a question. You brought this up in the last episode quite a few, and you kept saying FHA, physician loans, blah, blah, blah. And I'm like, yes, I want to hear all these loans because I want to buy a property. So what are some special mortgage considerations and strategies for veterinarians?
Okay. Well, let's just go through each loan product real quick, and I'll give you some broad things on it. Because there's a lot of misinformation about every single one of those that you just mentioned. A lot of people just think like FHA, first-time home buyer. No. So let's pretend you're a first-time home buyer. If you go conventional, that means the minimum down is really 5% on conventional. And if you're a first-time home buyer, as long as you can qualify and meet the specifications, it can be as low as 3% for conventional. It's not 20%. FHA is the minimum down is 3.5%. Okay? So FHA is technically actually a higher minimum down than conventional if you're a first-time home buyer. And if you're not, well, 3.5 versus 5, it's not 3.5 versus 20, right? Both are great products. If you are putting more down, especially in this market, and you have a really good credit score, conventional is probably going to get you a better deal. Okay? If you are putting less down, because there are pricing hits the less you put down on the conventional side, meaning the same level of closing costs would get you a higher rate. The less you put down, the more conventional, at least in this market as of June 2024, can get more expensive, higher rate, higher cost, and the less pristine of a credit score you have. Conventional is much more strict than FHA. And so if you have a pristine credit score in your first-time home buyer, maybe conventional does still make more sense than FHA. If you don't have pristine credit, your debt-to-income ratio is a little bit tighter. We can talk more about what that might mean later. FHA is a little bit more forgiving and might offer you a better deal. So one's not better than the other. It just depends on your profile. And have your lender compare the different options. Like, what does a conventional look like for me? What does an FHA look like as far as what I'd have to bring cash to the table and what would my monthly payment be, right? Those are really the two numbers you care about. VA is better than the physician's loan. Hot take, but probably not super hot take. But I mentioned that because a lot of veterinarians ask about the physician loan or the vet loan, right? One, a vet loan or a physician's loan is a more specified product. Not everyone has it. You're going to have to do some research to see who offers it, where everyone offers, FHA, VA, conventional, right? So you have to do a little bit more research to find it. And for better or worse, veterinarians are not always offered it. Sometimes they are, sometimes they aren't. When I was looking for my first home purchase last October 2023, my wife was able to get it. We didn't use it though. We went conventional for a bunch of other reasons. And so the thing to look out on the vet loan side is that yes, it's $0 down, typically up to $1 million purchase price. So if you're under $1 million and you're a vet and you can find a good LO, loan officer, who has access to the vet loan, it is definitely something to consider, because $0 down is very enticing, right? But just keep in mind, and why I mentioned VA loan is if you happen to be a veteran and also a vet, well, VA is also 0% down too. Everyone offers it, so you're going to have a lot more lenders to choose from. The rates are lower on VA loans. There is no PMI just like there is no PMI on the physician's loan. So what ends up happening is with the VA loan, you can get the equivalent terms, so $0 down, but the rate's going to be lower, the payment's going to be lower, it's going to be a cheaper loan, less closing costs most likely, and you're probably going to have more of experts to choose from to be your trusted loan advisor because everyone offers them. So like you better kind of have VA loans if you're in the business. And so if you're a veteran and also a vet, go VA loan 9 times out of 10. Now, if you're not a veteran, which most people aren't, if you happen to also be a vet, well, again, if you're looking under $1 million for the purchase price, definitely consider it, get some quotes, but just be aware that, hey, it's a marketing tool saying no PMI. What's PMI? It's a little extra thing tagged onto your payment if you're putting less than 20% down. If you went conventional, it's always there for FHA, right? Sometimes it's $50, sometimes it's $300. It depends on your credit score and loan size. Just be careful. The marketing tool of the physician's loan or vet loan is that, hey, no PMI even with 0% down. But if the rate's 1% higher than it would be at 3% conventional, right? Ooh, and maybe there's $5,000 more of closing costs to get that higher rate on the physician's vet loan. Well, then, gosh, maybe the amount of cash you actually need to bring to the closing table is fairly similar depending on the purchase price, like within $5,000. And maybe the payment's $500 more per month on the vet loan because the interest rate's 1% higher, right?
Mm-hmm.
So you just want to compare all your options as a vet and know that what you really care about is what do you need to bring to the closing table, which is called cash to close, and what's your monthly payment going to be, including everything, right? That's really all you care about. And we can talk about closing costs in more detail, but those are all your loan options. What makes sense for everybody is going to be different. Your loan should be tailored to meet your financial needs, wants, and goals. So some people should go FHA, some should go conventional, some should go vet physician's loan. It all just depends. Does that answer your question? And I've said this on the last one. It's just every answer to every mortgage question is it depends. And that sounds like a cop-out, but it's true.
I do have follow-up. So it seems like, I don't know why, I always thought conventional, 20%. Is that misconception because of the PMI?
Maybe.
Okay.
Yeah, no, that's just a huge misconception. The minimum down on conventional is 5% if you're not a first-time home buyer, and it can be 3%, but it's not 20.
Okay.
If we're talking primary residences, not investment properties.
Yeah, and what is a first-time home buyer?
A first-time home buyer, I'm going to have to brush the cobwebs off of this one. It's not what you think it means. It has to do with, have you owned any real estate in the last, I think, consult your lender, it's either 2 or 3 years. I can't remember off the top of my head which one it is. But if you bought a home 20 years ago, and then you sold it or whatever 5 years later, and you've been renting for the last 15 years, you're a first-time home buyer. Even though you're not really, but you are in the eyes of a lender. So just know that. Consult your lender if it's 2 or 3 years. I can't remember.
So I'm a first-time home buyer, I guess, at this
Yes.
point. Okay.
Yeah. Whether that matters, I think people think it matters a lot more than it does. Because, right, it's not 3 versus 20%. It's 3 versus 5. But maybe you were going to go FHA anyway, or maybe you were going to go physician's loan anyway, in which case it didn't matter.
Okay.
Okay, so what else should vets consider about home buying that is unique to the profession?
There's a lot, actually. If you're part of our home buying webinar for veterinarians, go check that out on YouTube, by the way. Shameless plug. I mentioned this, but it's really unique to the profession to be able to Google all of your potential employers unless you moved cities for like the next 10 to 20 years, right? Like I could go, assuming I don't want to move out of San Diego, I could go Google all the vet practices in San Diego, right? There's not enough vets out there. There's not enough vet hospitals out there. There's a huge shortage. So when you're buying a home, if you're an associate veterinarian, how gainfully employed are you? Meaning, are you going to be at your current practice for the foreseeable future? You never want to leave. It's the great fit. Great. You probably want to buy a home that's close to that practice. Do you think you might change practices? Especially if you're a new grad, it is very common to change practices 2 or 3 times in the first 2 or 3 years, right? And that doesn't mean you shouldn't buy a home. It just means, hey, if you know that, hey, you got a buddy who's at vet practice A that you might be switching to in 6 months, or you kind of like that other new vet practice. They're the new kids in town, but they got the best medicine. They have vets who are practicing the way that you want to practice, and you're practicing at an older practice, right, for one way or another, and it's not a great fit for you long term, right? All I'm saying really is know who your potential employers are, know who your current employer is, and you don't want to be stuck with a current 10-minute commute only for 6 months later after purchasing the home, it turns into an hour commute, right? Because you don't have the option of working remote unless you want to do telemedicine. That's a whole other podcast.
Yes.
But like, I can work remote. I can work wherever. So I don't care where I live, but it is very unique to the vet profession to know totality. Where the heck are you going to work over the next 20 years unless you move states? Like, you can know that. So know that first and then buy accordingly. Don't buy and then figure out that your ideal practice is 50 minutes away. Unless you're okay with that. I know my wife would probably not enjoy a 50-minute commute back after work, after doing tons of surgeries, after getting emergency walk-ins, and then having to commute in traffic an hour back home. Ugh, right?
That would be terrible.
You might literally lose money on production because you would just be sad and produce less. Right. So location means something different to you as a vet than I think it does if you're not a vet. Does that answer the question?
Yes.
Oh, yeah. It has my mind thinking about non-competes. Just people that buy properties because, it's right next to the clinic. And then it's like, oh, you quit and now you have a 20-mile non-compete. So now you have to commute a lot.
Oh, gosh. Not 20 miles, Willie.
Whatever. That's the old school part. Now it's just 5 or whatever it is.
Just try not to have a non-compete.
Exactly.
Just don't.
So how do you plan ahead for how much cash you'll need at closing?
Good question. So here's the industry term. Cash to close. Everybody talks down payment, right? But that's not the amount of money you need to bring to the closing table. The amount of money you need to bring to the closing table is your down payment, whether that's 0 or 3% or 5%, or maybe you're going gung-ho 20%, 40%, whatever it is, right? So it's your down payment plus any and all closing costs. And closing costs depends on the market you're in. It depends on the city you're in. A lot of people like to use a percent of, the purchase price. I don't like doing that. 99% of the time, it's going to be between 8 and 13 grand. Sometimes if you're in a cheaper state, and the reason we have to give a range is your lender, your realtor, they have no clue what you're closing. Well, they have a clue, but they cannot tell you exactly what your closing costs are until the day of close. And there's a few reasons for that. One, of that 8 to 13 grand, there's going to be your first years of homeowners insurance premium that you have to pay at closing, right? That might be $1,000. That might be $3,000. That might be $5,000 if you're in Florida. Sorry, Floridians. The point is that can fluctuate by thousands of dollars, and that has nothing to do with whatever lender you choose, right? That's your homeowner's insurance. Title company, escrow company. Usually the seller picks the escrow title company. That's just the company that moves the money around, basically, during the transaction. And you don't really need to know exactly what it is for the purpose of this pod. The point is, some escrow companies are $1,200. Some are $4,000. And it always depends on a lot of different variables. And your realtor might not be the one picking that company anyway. Most of the time they're not. And so budget for $10,000, but also double budget for what if it's $12,000, $13,000, and assume no seller credit. What's that and why it factors into what you need to bring to the closing table? Well, part of negotiating a deal is that maybe you ask the seller to cover a portion of your closing costs, right? Maybe you even offer 5, 10 grand, 15 grand above the asking price, but then ask for 10 grand back in seller credits. Why? Because if you're putting the minimum down, maybe that increases your monthly payment by $50 per month, and it gives the seller 15 grand, but then you ask for 10 grand back, so the seller's still getting 5 grand more than what they asked for, so they're happy. But now, instead of needing to bring your down payment plus $10,000, you just need to bring your down payment. You just saved 10 grand, right? And so to answer the question, what is cash to close? What do you need to budget for? It's your down payment plus any and all closing costs minus any and all seller credits that you're able to negotiate. For financial planning purposes, especially in this market, depending on where you're at, probably just assume you're not getting any seller credits and be okay with it. And budget for at least 10 grand in closing costs, but be okay if it ends up being 15. And then you're good to go. And then you'll be pleasantly surprised if it's only 8, right?
Mm-hmm.
That's how I would do it. So,
And then any of the realtor expenses are the sellers, right? The seller has to pay that.
So we'll have to do another podcast about this to be determined. So up until right now, 99.999% of the time, the sellers would pay the realtor fees, meaning you should always use a buying agent, right? Because you're not paying for it and there's no data to support you're going to get a better price. In fact, you'll probably get a worse price because you don't know how to negotiate real estate, right? So you should always use a buyer's realtor agent because you're not going to pay for it. The seller pays for it, okay? And the seller pays for their own realtor too, if they're using one. So you don't need to budget for that. However, talk to your realtor now, bring it up. They're probably going to bring it up too with this whole NAR commission lawsuit thing that has happened. Again, I'm not going to go in the details of it. One, because I'm not a realtor, so I wouldn't say I'm the subject matter expert in it. But the long and the short of it is that might be changing. You might need to pay a portion, if not all, of your realtor's commission, which, depending on your market, could be 2 to 3% of the purchase price. That, I'm just going to say it, hurts first-time home buyers who are just now saving up that down payment and closing costs. Like, that could be an extra 10 grand, 20 grand, depending on the market you're in, right? That sucks. You might not have to pay for it still, though. It's to be determined. Every market's going to be different, and maybe you negotiate a seller credit to cover it anyway, so it's literally doesn't matter. Everybody's kind of scrambling in the industry right now to figure out what's going to happen with that. So to be determined. I think it doesn't go into impact until July, so we really haven't seen the lasting impacts of it yet. Nothing might happen. Everything might change. It might be somewhere in the middle. It's a whole other podcast that I could go down the rabbit hole of what ifs, which I'm happy to do, but it's just, no, historically, you don't need to pay any realtor fees. Moving forward, ask your realtor. You might not have to still. You might have to. We'll see.
Mm-hmm.
Okay.
All right.
It's a big deal.
Yeah, it's crazy, right? It's like with student loans. Once you get used to the rules being one way, they change them. So.
Yep. Real estate changes every month. Mortgage changes every month. That's why you need to get a good realtor and get a good loan officer who can explain all the changes, because it's nuts out there.
Yeah. So, David, could you tell us about your personal experience buying a home?
Oh, yeah, that was something. So I have a good story. This is why I like real estate. There's so much drama. There's always a story with every property. So I bought with my wife. We closed October 2023. Luckily, before this NAR commission lawsuit, so I didn't have to pay any realtor fees. And I loved the realtor I worked with. Shout out Ehab in San Diego. Go look him up. He's a great realtor. So the story with my purchase and what it was like is, well, luckily, because I'm a loan officer, I know a thing or two. Like, I knew what to expect. We knew how to budget for it. We knew we'd qualify, right? Like, crossed all I's and dot all the T's that most people don't, right? So the loan process was really easy for me because I made sure that we weren't going to go for something that we weren't going to qualify for, right? And so, couple things on the process. It takes, at least out here in San Diego, my wife and I were looking every single weekend. It was almost like a full part-time job on the weekend. We would see 4 to 5 properties every single weekend for 3 to 4 months straight, going with a realtor. And we're picking the properties. We don't need a realtor to send us properties. Mainly, a good realtor wants to see your reaction to the property, to see like what you don't like, right? So they could advise you on things that you wouldn't think about, honestly. And so it was stressful because we fell in love 4 times. The 4th home that we fell in love with is this one. And it's hard out there right now. Even if you have all your ducks in a row, and I had to talk my wife through this. If you have all your ducks in a row, you got the good realtor, you got the good lender, you know what you're doing, you're a hard negotiator, you might be the most qualified financed buyer and still only have a 1 out of 5 chance, a 20% chance of getting your offer accepted. Because inventory in a lot of markets are just very low right now. So even with higher rates, it is still a competitive market. If second rates go down, it's going to get even tougher. Yeah, your payment might be a little less or not because the price is now higher. That's a whole other discussion. But in our experience, we had to be okay with, okay, we got a 20% likelihood of getting our offer accepted. That means we're going to fall in love. I coach people on this 10 times, right? And you're only going to get 2 of those 10 offers accepted. And you don't want to make an offer on something that you're not in love with, right? You don't want to get stuck with the property that you didn't like. Otherwise, it was a waste of money, right? So still be picky with your offers, but just know that it's going to take 3 to 6 months of getting offers denied, making a new one. And as long as you can keep that it's a numbers game mentality, then it's a lot less stressful. Because what a lot of people do is they get that first offer denied, they saw the home, they fell in love with it, they imagine their kids there 10 years from now, right? And they didn't get it. And then they want to crawl in a hole and give up. My wife and I we did cry on the third home we lost out on. We cried, we beat out, there was like 12 offers on it. That one, there was like 6 or 7. We were in the front running. The agent had met us so the second property we put an offer on was the same selling listing agent as the third property. So we lost out on that second one. Glad we did because the house we bought ended up being better than that. The third one we saw, she already knew us, so she liked us. So we thought we were very confident. We put in a really competitive offer, and she even called my realtor to tell him the day we were expecting to hear back, we were going to give it to you guys. But literally 5 minutes ago, we got a cash offer that beat you guys by an absurd amount, and so I have to take it. And she was like, I'm really sorry.
Wow.
I wanted you guys to get this one. And so we cried from that one, right? And so even knowing this, we still got emotional, but we kept on moving forward because I knew the odds are 20%, even if we're the strongest buyer. Heck, we're only on offer 3. We shouldn't be under contract yet, statistically. So just keep that in the back of your head. So that helped me during the pre-under contract. And then to just answer your question, what was my experience like? Even once we found that perfect home, we put in the offer, we got it, it all worked out great. It was still super stressful, not because of anything related to the mortgage. Like I said, we weren't going to go for anything that would have any trouble of qualifying. I made sure of that. And we were cleared to close in like 3 days. So I had everything on a silver platter for everybody. What was really stressful is the seller of our property did not disclose that they were also trying to buy a property themselves. So they were selling the property and going to buy another property at the same time to be their new primary residence. So they fielded offers from everyone without disclosing that the sale was contingent upon them finding a replacement property for themselves, which you're really supposed to disclose that. I'm renting. I could go month to month. I don't care. Why should I play hardball with you if you're not a real seller, in my opinion? Because what happened is we put an offer. We didn't hear anything back for like a week. And my agent followed up with their agent every single day. Hey, what's going on, right? They're like, we're working on it. We'll let you know. They had a property under contract themselves that fell out of contract because the sellers didn't like their home inspection on their replacement property. And so then they came back to us and said, hey, this is what we were really doing. We need to wait. We want you guys to be the buyers. We like you the most. You have the most competitive offer, and we like working with you. Can you hold on? We got to go find another property. And we're like, are you freaking kidding me? Maybe my offer would have been less, Maybe we would just look elsewhere because, I'm serious. Are you guys? What you should do, by the way, as a seller, in my opinion, is if you want to do this, sell your home first, rent short term, and then be a cash buyer, right? Or don't be a contingent seller or a contingent buyer. You're a much stronger player. But either way, this is what they're choosing to do, and they didn't disclose it. But we kept in it and said, okay, we'll wait. And our offer stands just because inventory is so low. We were looking every weekend. We didn't find anything else in our purchase price range that we were comfortable with that was better than this one. We couldn't. If you went lower in price, it just didn't fit our needs. And if we went way higher in price, we weren't comfortable with it, right? So we're like, okay, we'll keep on looking, but we'll wait. After a month, finally went under contract. They found the replacement property. That's when we were able to start the loan process to actually get clear to close within 3 days. And to wrap this story up, because I don't want to take up too much of your guys' time with it, but I do think it just shows like how stressful the whole thing can be, loan or not. We were clear to close in 3 days. The second we let them know, hey, we're clear to close, you guys ready? We can close on the close date or we can close now. Up to you, whatever you want. And they said, we just fell out of contract on our home again.
Oh, no.
Yeah. And we're like, are you serious? And they're like, yeah, we didn't like the home inspection. Like, there's something on the front. And I'm like, you didn't see it? Like when you put in the offer, but okay. But what ended up happening is they had the guts to tell us, hey, we just fell out of contract again. So we got to go find another property. But by the way, we're past the home inspection contingency date. Can you lift all your contingencies? And what that means for the listeners is when you buy a home, you put something called an earnest money deposit forward, which in California, it's always 3% of the purchase price. It's part of your down payment. So if your deposit is 10 grand and your down payment was 20 and you had no other closing costs, that just means you give 10 grand up front and you bring the remaining 10 grand to cover the rest of your down payment at close. So it's not an extra expense. It's part of the whole package that you pay up front and you pay the remainder at the end. But here's the catch. If you back out of the contract for after you've lifted contingencies, they have the right to keep that deposit. If you back out after you've lifted the loan contingency, after you've lifted the inspection contingency, it basically says like, hey, we have 7 days to do our home inspection. And if we see something we don't like on that home inspection, we can back out before the contingencies lift and get our deposit back, right? It protects you. And so they had the wherewithal to say, hey, we just fell out of contract. We don't really know when we're going to close, but it's time for the original contract to lift your contingencies, which if we did so, it would lock us into making it so that we could not put in other offers on other homes. We had to write it out. And if we didn't, we could lose our deposit, right? So, gosh, we were pissed, right? Now, we were still actively looking. We still didn't see anything else that we liked more. And there was still a contract date where everything would just cancel if they didn't have their stuff together by X date, right? So we're like, okay, the real cost is as long as we're willing to write it out, it's our time. It's not our deposit.
Mm-hmm.
If they can't figure their stuff out by that X date, we don't lose our deposit. We get it back. It's just we don't get the house. So we're like, okay, let's keep on writing it out. Up until that point, we were just yes people. We're like, yes, whatever you guys want, we'll do it for the house, like responding in 2 seconds. The lifting contingencies part, you have 3 business days to get back to their request to lift your contingencies before they have to send another doc that forces you to legally lift it or cancel the deal. And so now my realtor was like, let's wait. Let's just not respond. Let's give them some time to like freak out about this. We don't have to. We got 3 days. Who cares? And they got nervous after the second or third day. At this point, they also said, the home inspection came back great. One reason we liked the house is it looked like it was in good shape and it wasn't a flip. It was well taken care of. And nothing at the home inspection scared us except, there was probably about 10 grand worth of like real fixes that needed to be done. Nothing urgent. Really more like 5. So we said, hey, here's the home inspection. Here's 10 grand of stuff that we didn't know about going into it that wasn't disclosed, which is normal. How about you give us a 5 grand seller credit? We'll split it. And that covers like the majority of the things that we'd want to fix immediately after moving in. They said, sure. But instead of giving you a seller credit, why don't we just lower the purchase price by 5 grand? Which makes no sense. They get the same amount of money. And what happens is I save $20 a month on my monthly payment on a loan I'm probably going to hold for 2 years. No, I want the seller credit so I could save $5,000, not $20 a month for 2 years and then lose $2,500 after that point, right? It's the same difference to the seller. The seller's realtor didn't know why he wouldn't take that deal. It's the same net number to him. My realtor was like, we've tried to explain it. This is insane. And it's after that they hit us with the lift your contingencies. We fell out of contract. So by holding and not responding to them immediately and making them nervous, they came back before the 3rd day and said, never mind, we got another house under contract. We're good to go. Like, can you please lift your contingencies now? And we said, give us the seller credit. we're in no rush. My realtor was like, my clients are renting. They're not going to be homeless. They can keep on looking elsewhere. You know, what do you want to do? Give us the seller credit. It's the same number. And they did. So we saved $5,000 there and then we closed. And so that was a long story, but it's just to say real estate is stressful. Even when your loan's fine, everything's going fine on your end, there's a whole other party to this deal that if you don't have people in your corner to negotiate for you, because I didn't do any of the negotiating, my realtor did. He did all those tough conversations because I would have screwed it up because, one, I'm not a realtor, and, you know, I'm emotional if it's my transaction, right? And so, you know, it all was fine. We love the house. We're glad we did it. But gosh, it was a wild ride. And it was fall in love 3 times, crying the 3rd time when we lost out on it. On the 4th one for 3 months, it was just like an emotional roller coaster of like thinking we're going to get the house, then not getting it. And now we're getting it again. And it having nothing to do with us. It was the sellers in this case, right? So just expect all that and you'll be fine. And now we're fine.
Okay.
and I met the sellers too after the transaction. Very nice people. So I have nothing against them. It's just, you know, they're not real estate people. You know, I would have done things differently if I were them, but they were very nice people. And, you know, I text them when I get some of their mail and they pick it up and they're great. So it's fine.
So after that stressful event, you know, now could you talk about how a home purchase fits on the context of financial planning?
Yeah, just don't buy a home, I guess. You'll make I'm just kidding. So, no. A home can be the best investment in the world. Like, homeowners have 40x the net worth as non-homeowners, right? Like, it is a great long-term play. Emphasis on the long term, though, right? Because from a financial planning standpoint, you want to make sure that you're not too house poor, right? And so, just like mortgage, with anything financial planning, the answer is it always depends. But in the context of financial planning, we want to make sure that, hey, after the transaction's completed, do we have 3 to 6 months reserves still, right? Do we have reserves for, you know, furniture, for moving costs, for everything, plus your 3 to 6 month emergency fund, right? That's where we want to be. Is that mortgage payment, including taxes and insurance, like, is that going to make you poor? Or is that sustainable? And then we have to have those conversations of, hey, maybe you can push it a little bit if you don't have any auto loans, right? Maybe you can push it a little bit, your mortgage payment, to get the right property. If you don't have giant daycare expenses, if you don't have other debts to pay, and if you know, what's your income look like? Are you a rising income trajectory? Are you on a downwards trajectory? Are you staying the same, right? It's all part of your financial plan, and a good financial planner will work with your loan officer preferably to make sure that we complete the transaction in a way that, one, you're not just qualifying, but you're qualifying for the right home loan, because you can structure it 100 different ways, and that after the transaction is completed, you'll have a housing payment and reserves that will also allow you to attain all of your other financial needs, wants, and goals, right? And if eating out less and if going on less vacations and making sure that you don't have any auto loans allows you to push the envelope a little bit on the home that you might refi later anyway, then cool. Just know what the trade-offs are, right? And again, it's a long-term play. If you're in San Diego, plan to hold it for 10 plus years, you're going to be fine. If you think you're only going to hold the property for 2 years, 3 years, you're in danger zone. I don't know why you buy, honestly, in the first place, because you're for sure going to pay some sort of realtor cost when you sell. It's generally, before the SNAR lawsuit, maybe you have to pay 5, 6, 7% cost on that future sale price, which eats into the maybe a little bit of appreciation you got in the first 2 years, right? And maybe you don't get appreciation in the first 2 years, right? And so probably, especially in this market, if you aren't planning on holding long term, I'd be really cautious on buying. And if it's you want to buy because you think it's going to make you money, if it's over 2 to 3 years, you're probably way better off renting, honestly. If it's for more than 10 years, depending on the market, and if you know what you're doing, of course, real estate's still a great investment. So to answer your question on the financial planning side, you want to make sure you have trusted professionals who know a thing or two about financial planning and real estate to make sure that you're staying within the guardrails to still accomplish all of your financial needs, wants, and goals outside of real estate, and that this transaction is not going to derail you. That was a mouthful, sorry.
That was a great answer. All right, David. So that brings us to our last question. What is your best advice for our listeners?
Talk to me. I'm just kidding. Work with me. Let me be your financial planner. What's the best advice is, if you're listening to podcasts like this, you're probably going to be okay because you're doing your research, you're doing your due diligence, you're interested in learning the ins and outs, right? But then again, you're a veterinarian, right? Know what your time's worth. Is it worth becoming an appraiser so that way you know how to value properties just so that you can buy the best deal for yourself? Probably not, right? Go see more patients, right? So my best advice specifically for veterinarians is know the value of your time and get professionals who you trust to help you through this process, right? Because if you can have a financial advisor who knows a thing or two about being a vet and who knows a thing or two about real estate, walk you through the process to teach you what you need to know that you don't know what you don't know, right? And that saves you 20 hours of research that you might get the wrong answer to because there's a million different things on the internet, right? Cool. That just made you $5 more grand that month, 10 grand more that month because now you could go see more patients, right? Do a relief shift or two. So time is money for vets. And again, my best advice is find people you trust to help you with this process. That's really it. And don't go crazy on auto loans. And that's not just for vets. Like, I see auto loans with $1,200 per month payments and I can't give them a mortgage. And it's like, dude, it's like 20% of the mortgage you want. Like, come on. That's my advice.
No auto loans. Noted.
All right.
Yeah.
If you'd like to get in touch with David about vet-specific financial planning, check out slpwealth.com or email David directly. His email address is david@slpwealth.com. Thanks for joining us again today, David.
Thanks for having me. Sorry for talking too much, but I can nerd out about this forever. Thanks again. I appreciate it.